You want a mortgage to buy a house, and you know lenders are going to look at your credit score. Hi, I'm Lisa. In this episode, we're going to look at what goes into a credit score. United States has 3 credit bureaus. They're Equifax, Experian, and TransUnion, and they each calculate their own credit score, also known as FICO. You can ask each of these credit bureaus for a free credit report at annualcreditreport.com, but that report will not tell you your FICO score. You can get your FICO score for free from your bank or lender, or there are also services that provide it for a fee. So how is the FICO score calculated? Well, 35% of it comes from your payment history. Late payments get a ding. 30% comes from your credit utilization ratio. This is how much of your credit limit that you use each month. 15% comes from the length of your credit history. The longer, the better. 10% comes from your credit mix. What type of debts have you had previously? And 10% comes from credit inquiry or new credit. Let's take a look at these in more detail. The biggest influence on your credit score is your payment history. Your credit cards and debts will show up here, but things like your utilities, they do not show up unless you are late. So that means that paying rent and utilities on time will not help you, but being late on them will hurt you. The next biggest influence is credit utilization ratio. Of all your credit limits, what proportion do you use? You want to be between 1 and 30%. Under 10% is best. So don't put more than 30% of what you're allowed on your credit cards. You do want to use your credit cards a little bit though, to show that you can be a responsible credit user. Length of time that you have had to demonstrate your credit worthiness accounts for 15% of the score. Longer is better, but most conventional lenders like to see at least 2 years of credit history. 10% of the FICO comes from the mix of credit that you have had to demonstrate your credit worthiness. Each type of debt contributes to a different trend line. So card payment is one type of debt that is different than credit card debts, which is different from student loans. Mortgage lenders typically like to see at least 2 different trend lines. The last 10% comes from new credit inquiries, which suggests that you're applying for new credit and therefore there may be unknowns that are not reflected in the present credit report. FICO scores over 800 are excellent and banks will be fighting over each other for your business. Anything over 740, in fact, is very good. 670 and above is a good solid score. Down to 580 gets you into the subprime range. You'll be able to get a loan, but it's going to cost more. Under 580 is going to be hard. So what can you do to improve your credit score? Pay your bills on time. This accounts for 35% of your score, and luckily, this can be under your control. Second, use 1 to 30% of your credit limit. Either put less on your credit cards or see if your credit limit can be increased. Remember, the best is under 10% utilization. Third is credit history. If you can, postpone home buying until you have at least 2 years of credit history. Unfortunately, for many people, you can't do anything about this. But what you can do is start educating your teenagers about the importance of establishing credit. Fourth is debt diversity. Ideally, if you have car loans and credit cards, then you have at least 2 trend lines. If all you have are credit cards, no matter how many cards you have, that's only 1 trend line. Last, shop and compare lender cost within 2 weeks. This is so that lenders will pull credit within a closed time frame and subsequent inquiries will be considered shopping around and won't hurt your credit. That's it, folks. Now that you know what goes into a credit score, there are things that you can do to help yourself. If this is helpful, please give me a thumbs up, share it with your family, and subscribe. Please check out other videos I have for first-time homebuyers. Thank you!